Let's ask Adam Parker. He is Trivariate Research CEO and founder. With me here on set. What a month. It's good to see you.
Yeah, good to see you.
What happens now?
You know, I think after such a historically bad Q2 and Q3, it's not surprising that you can get a pretty strong counter-trend rally. I think
you weren't expecting this kind of a move, were you?
For sure not. For sure not. I think we did talk about rhetoric maybe was more negative than positioning. Mm-hmm. Right? Everyone knows the obvious. Inventory is built, earnings are too high, there's quantitative tightening. I think this rally was more about people thinking the Fed is getting closer to pausing or speculating on when they get directionally dovish than it is fundamentals. What I've been talking most with my clients about in the last few days is this thing I started socializing with you a month or two ago. Could this just be a very slow decline? Kind of an erosion, not an implosion. And then I can then look and say, you know what, there's things that are probably on sale if that's the case. Cyclicals that are so cheap, they're discounting an implosion that's not likely. Quality businesses that are now barely above where they were before 2019, yet they can probably grow through this decline. And so maybe 2024 earnings are below 2023, but maybe there's a bunch of businesses that I still think are a decent deal in that light. And I think that's been kind of dominating my investor conversations in the last few days.
To your point about how negative everybody and everything seems to be, Lloyd Blankfein tweeted something a couple days ago that I want your reaction to because it speaks very much to that. He, of course, the former Goldman Sachs CEO. Seems everyone, all caps, negative on the market with sticky inflation, more rate hikes, other bad stuff ahead. Yet, inconceivable for all pundits to be right, but often all are wrong. Positives may be lurking. Fed pause, Ukraine truce, China lockdown end, etc. Sentiment can shift suddenly. What do you make of that?
It can shift suddenly. I mean, I think we have a very high nominal GDP starting point, the result of, this pig through the snake on COVID, so to speak. So that's going to work its way through slowly. I think what could surprise people is, we just have a little bit of a decline, and it takes longer to totally decline. And then there's businesses that are pretty good companies. Like we're in our research, I think you saw it this morning. Home builders trade somewhere between 2 and 5 times earnings. So let's say they're 30% too high, 40% too high. Can I still buy best-in-class home builders at 5 times earnings if the real number's 9? Maybe.
I know, but you've
in the past, I haven't been there. Now they're down a lot, and I think maybe it's more interesting, right? I mean, it's always entry point, right? As you know, I love energy and I love metals. They're really cheap. They're embedding a massive earnings decline, and it might just be an erosion and not a massive decline.
But I feel like you have been talking about more of an implosion over these last many weeks, at least in earnings. Aren't you looking for earnings to come down like 30 to 50%? Or
no.
How much are you looking for them to come down?
I think around 220 is reasonable. The street's at 235, so you're kind of in that 12% too high range. I'm more meaning the fact that maybe it'll be 7 or 8% too high, but then 24 will be below 23. We've never posted a number like that. No, I think it's just that the multiple is the hard part for me, right? The volatility of that price to earnings ratio, it's far greater than the volatility of the underlying earnings. So when the Fed gets anything dovish, we know the multiple's going to expand. What I don't know is the earnings going to be a little bit lower. That's the tension. And if I have a 2-year yield that's well above 4%, it's hard to think the multiple is going to expand a ton. I think that's the tension.
Do you think the Fed's going to extend the rally, or kill it this week?
If I were guessing, and I'm not good at that, but I would say they're going to kill it.
Well, you got to model in certain things. You're good at that.
I think they're going to kill it. I think they're going to be a little bit more hawkish than the last couple of weeks of sentiment would otherwise dictate. I think they're going to say we still have some inflation issues in certain areas, and we want to get it under control. But listen, that would just be using the prior 10 conversations to lead to my 11th conclusion.
I mean, Shepardson of Pantheon Macro says the conditions are falling into place for potentially the Fed to do its last hike in December. Unambiguous signs of weakening labor demand, falling business investment intentions, falling rents, collapsing support for overstretched profit margins. Change is coming, making it much more likely that the Fed's final hike will be in December. Is that like a tremendous outlier view? Can you get your arms around that?
I don't think that's an outlier view. I think the consensus has moved toward some pause at some point in the next 6 months, and it's moved there pretty quickly. I think they've been consistent that CPI is one of their main governors. I remain pretty high conviction the CPI will remain elevated. So whether they're waiting for some 5 handle or I don't know to really get dovish, we'll see.